Welcome to Within the Frame, where we bring today's most pressing issues across the globe. I'm Kim Mok-yeon. In a surprising move, South Korea's central bank has cut its benchmark interest rate by 25 basis points to 3%, citing rising downward pressure on economic growth. The decision, announced after the last policy meeting of the year, comes amid stagnant GDP growth and a slowdown in exports. Although inflation remains stable and household debt growth has eased, the Bank of Korea is focused on boosting economic activity, which has been weaker than expected. The rate cut follows a similar move last month and is aimed at stimulating consumption and investment. Some analysts, however, warn it could exacerbate risks such as higher household and corporate debt or a potential housing market bubble. The central bank has also revised its growth forecast for 2024 and 2025, lowering projections to 2.2 and 1.9% respectively. For more on this, we invite Song Soo-young, College of Business and Economics professor at Chungang University, to the show. Welcome to the program, Professor.
Thank you for having me here.
And also joining us is Hwa-Kyun Kim, Professor of Banking and Finance at Texas A&M University's Mace Business School. Great to have you, Professor.
Pleasure. Thank you.
So let's start with Professor Song. The Bank of Korea lowered its benchmark interest rate for the second consecutive month, breaking expectations. What do you think is the reason behind this decision?
I believe that the decision, which was announced that the 25 basis points decrease in the base rate in Korean economy, at least too many analysts and experts has mentioned in the, according to the October survey, they have out of the almost more than 80% of the people and the governors mentioned that the November the November decrease of the interest rate would not be likely. However, I don't think it is a surprise because considering the poor performance, particularly in domestic economy, it is really necessary, but better than never, but actually it is a little bit late to reinvigorate the economy and to keep up with, particularly the international trade has always troubled to the Korean economy right now because not just because of the election of President Trump in the U.S., but clearly the international trend is towards the protectionism, and many economists have warned that. So to that regards, we have to rely much more on the domestic economy recovery. Otherwise, we are going to most likely to lose the momentum. So I think I welcome this step and decrease of the interest rate, and the further decrease of the interest would be desirable in the future.
Right. And what about Professor Kim? It looks like the rate cut seems to signal that the domestic economy is currently in a weaker state. In fact, the BOK revised its growth forecast, like I said, for next year from 2.1 to 1.9%, and this is also lower than IMF's forecast. What are the downside risks to the economy that led to the Bank of Korea to lower its growth forecast?
Yeah, so I agree with what Professor Song said, and basically it looked like a surprise movement because of the concerns about the exchange rate fluctuation depreciation recently. But I think the Fed lowered the rate actually last time, so I think the Bank of Korea also thought that there was some room for the lowering the rate if there's a reason. And as you just mentioned, the economic forecast was rather bad, and also protectionism and all this kind of things kind of say that the domestic part is going to be important, and the uncertainty has been higher. So if you look at the Governor Lee's the comments this time, that out of like 6 the Monetary Policy Board members, not including the governor himself, basically the 4 of them actually agree that the rate cut is a good idea, while there are 2 who oppose this and then want to stay put. So I think there was some disagreement in terms of the decision making itself, meaning there's uncertainty. And then when there's uncertainty to both directions, usually the downside part is more focused if the BOK is trying to be more averse to ambiguity or uncertainty. And the biggest factors for the downside is, of course, related to the weak, the consumption sector as well as the investment part. So the domestic, the consumption and investment sector are relatively weak, and then I think clearly that's going to be a concern, and that actually can lead to lower rate. And the household debt has been really high. And there are always, the two sides of the story, because if the interest rate is getting lower, then it can actually boost further debt supply. Therefore, it can actually hurt in terms of the size of the debt burden for consumers, as well as of the firms. And also the real estate sector could be problematic because it can actually make the price even higher in terms of the real estate price. But at the same time, the existing debt is really high. Therefore, lowering the rate actually may just alleviate some concerns about, this debt burden. So I think that was probably the biggest factors in terms of the downside risks.
Right, and like our Professor Kim just mentioned, household debt and housing prices in the Seoul metropolitan area are showing signs of easing in the fourth quarter. Now, there are concerns that the rate cut might provide a stimulus. How do you view this, Professor Song?
Yeah, actually, Professor Kim has mentioned that the problem associated with some interest rate decrease associated with some property market bubble. But clearly that could be a problem. But however, in Korea, I believe that the government debt is relative against the GDP is very low. When we consider the other countries' government debt against the GDP is very high, more than 100%, and even Japan has maintained 250%. But however, our country's government maintained that its rate, the rate is just around 60% and 50%. Or that is exactly why the private part or people's has bear the burden of the high interest rate. So to that regards, we don't have to worry about some household debt increase, but we must be careful about those low interest rate and too much borrowing is flown into the property market. That should be controlled by some measures, microprudential policies such as loan to value or debt to income or debt to service ratio. That could be very helpful to restrict and the household debt increase, particularly and in the house industry market. So even though the high interest rate is even very burdensome to the economy and the privately, particularly in some medium and low-level industry. For a good example is in 1983, the Weinberger, who is a Dutch economist, has mentioned that the high interest rate could drive the inflation, such as stagflation, because of it could increase the burden in working capital for the medium and the small industry and the enterprise. So to that regard, I believe that don't have to too much worry about the household increase, rather decrease the base interest rate and supply more money. And even there is some kind of inflation is possible, but still it needs to reinvigorate Korean domestic economy. It's much more necessary step right now. And that is why I hope, and then the governor chairperson of RE, Chang Young-ri, has started some declining cycle of interest rate.
Right, and also despite the BOK's rate cut last month, the interest rates on household loans from banks have continued to rise for 3 consecutive months. What do you expect for the movement of bank loan rates following this latest rate cut, Professor Song?
As far as I'm concerned, that several governors may be worry about this further decrease could provoke or stimulated some house property market investment, but that should be contained relatively. easily. But what need our economy is reinvigorate the growth rate. That is more necessary and very immediate step to be taken. So, but that only helps just to 25 basis points decrease of interest rate just to help the economy to grow 0.07%. That was mentioned by Governor Chairperson Lee. So what is now more required in Korean economy is a fiscal expansion policy. Don't need to worry about the budget balance or other things, but that is far beyond our concerns about some stagnating economy right now.
Right, and with the BOK's second consecutive rate cut, the interest rate gap between South Korea and the United States has widened from 1.5% to 1.75%. Professor Kim, how do you think this will affect the exchange rate, the value of the Korean won, and the market in general?
Yeah, so the simple economics is that if there are like a wider gaps in interest rate, then clearly, the money or capital will flow into the higher, interest rate countries because it's obviously, better return, right? So clearly, according to the simple economics, then we expect that, the dollar is going to be getting strengthened for other reasons as well. But so I think, we expect at least in the short term that fluctuations of this Korean won against the dollar is going to be higher. And also there's a chance that, the Korean dollar, the exchange rate may just increase to like currently as around like a 1,400 per dollar, but maybe it could go more than that. So clearly it's going to get worse to some extent. But I mean, there are some real factors as well in terms of determining the exchange rate. So overall, it's about like demand supply of like, the currencies. So if somehow, the domestic economy gets strengthened and also the exports getting better, then clearly dollar's going to be supplied to the economy because, the Korean economy earns the foreign currencies by selling this stuff. So hopefully, I think, if this affects positively on the Korean economy, then I think the backflow from the other countries to the Korean economy can probably alleviate this problem. So it's not too huge, but clearly at this stage, 1,401 is not like in a steady state. So hopefully, I think it goes down to about 200 per 100 per dollar. But for the time being, it's probably going to be staying there or slightly higher for the time being.
And also in October, 5 out of 6 members of the Monetary Policy Committee agreed that the benchmark rate should remain unchanged. There are different views on whether the further cuts should be considered. Professor Song, what's your outlook? And why do you think internal opinion of the committee has changed?
Yeah. Actually, according to the Wall Street Journal survey, that 19 out of 21 so-called experts in Korean economists has believed that no more rate cut in November, but actually it was broken. And also, I agree with Professor Kim's concern about according to the interest rate parity, the higher interest rate and the very robust economic growth in the U.S. Clearly, that could appreciate U.S. dollar against the Korean won. But that appreciation of US dollar is true to most of other countries, not only to Japanese yen or Chinese yuan or other pesos or whatever the currencies. So that means as long as we do not much depend upon the export to the US and rely on some expand our dependence from the importing of the energies from other countries other than US and some other smaller or some exporting energy countries such as Southeast Asia or India, then the burden of the depreciation of Korean won could be relieved. Therefore, what is the best strategy or portfolio policy for the government, Korean government needed right now is don't worry too much about the depreciation of Korean won, and rather we expand our portfolio in international trade and reduce some dependence on the US exports, and rather make use of the trade with China, India, and the other BRICS countries, whatever, even Russia. So I think the current situation under the future president of US, the Donald Trump, this could be a really very risky situation. But however, when we think of the other part, as long as we could be using these opportunities to expand our portfolio into other international trade, this could be a really good moment to improve our Korean economy's resilience and sustainability in the future.
Right, and speaking of Donald Trump, attention is also focusing on the upcoming U.S. Federal Open Market Committee meeting next month. The key U.S. economic indicators, including November CPI and Producer Price Index, will be released on December 11th and 12th. Professor Kim, what's your forecast, and how do you expect these reports to impact the FOMC's decision in December?
And there are multiple ways and easy and hard ways to forecast inflation. One that I think is quite simple in terms of this economic view is you can take a look at the nominal and the real interest rate difference. And I think that typically conveys the expected inflation plus some risk premium. So I looked at actually the one-year treasury rate and then also the corresponding the tips with the remaining one-year interest rate adjusting for the coupon so that you can compare. And then the difference is about 2.6%. So that's the expected inflation plus some risk premium. So if we further adjust the premium, which is about like 0.5, then I think we're to 1%. Then I think the risk-adjusted inflation forecast using the interest rate is about 2.4 to 2.55% or something like that, according to my forecast. So this is slightly lower than the last reported inflation of 2.6%, but still it's higher than 2.0% that normally the Fed actually strives for. So the likelihood of lowering the rate is probably the higher than 50%, but still it is not exactly sure because it's around like 2.4 to 2.5.5. 2.55, so it's not like way lower than the 2.6%. So chances are the inflation the report is going to be somewhere in between. And also consistent with this view, the FedWatch statistics actually show that it's about 60% chance or 70% chance somewhere in between to lower the rate. So I expect that inflation report is going to be important, but it's not going to be very different from like what I just said.
And it's largely expected that the U.S. Fed will keep its interest rate unchanged at the final FOMC meeting in December. Do you agree with such speculations, Professor Song?
Yeah, considering because now U.S. in some winter season and the Christmas season, that could always prop up the consumption. So considering that situation, even though the year-on-year or seasonal effect consideration, the inflation rate maybe remain a little bit higher than 2%, as the Professor Kim has mentioned, then most likely the FOMC would like to stay what it is right now. And I think in the next 2025, the January or February, they are observing that the magnitude of the consumption expansion and the jobless claim decline or some employment and unemployment rate, they are going to decide most likely in January. And as long as the economy is just to remain what it used to be, and then I think in January they most likely to reduce the 25 basis points. And that is actually there is a divergence and the dichotomy between the U.S. and South Korea and some other international countries' economy. So currently, I expect there is divergence is getting bigger and bigger. So it is like some kind of there is some trade barrier, and then Donald Trump has increased the tariff against Mexico and Canada by as much as 25% and 10% extra against the tariff. And then we are going to wait and see what was going to be or played out in the international trade.
Right. As mentioned, there are growing concerns that incoming President Donald Trump's trade policies might influence the Fed's actions. Professor Kim, what's your view on this?
Yeah, so I think the overall effect is not always clear because the tariffs and other protectionist type of the approach has both sides actually. But the simple part is if the increase in tariff actually indeed realized, then clearly that will increase the consumer prices. As we know, I live in the U.S., but clearly most of the products are made outside of the U.S., as we consume things. So clearly that will increase the price level and then inflation is going to get higher. And if the expectation about inflation is getting higher, then the Fed actually is going to increase the interest rate to fight against inflation. So actually that would be against what the President-elect Trump wants, because usually he wants lower rate actually to boost the economy. So in this case, it's going to be somewhat complex. But at the same time, if as intended, somehow this tariffs and the trade policy works so that it makes the U.S. economy boosted and then, they afloat, then maybe that also leads to lead the Fed actually to increase the interest rate because they don't want the economy to be overheated. So overall, I think if these kind of things can increase the interest rate, because of this policy, but at the same time, if the tariff doesn't work well, then the economy now is just going down, then clearly they may lower the interest rate. So the indirect effect is going to be more about whether the economy is going to be moving into more positive direction or negative direction or staying good or bad, rather than like a trade policy itself. And I think there will be some fights between the government and the Fed, but overall, I think it's going to be interesting to watch for the next 2 years.
Right, so we'll see how the situation changes with the Trump administration. Now, amid this Trump risk, Professor Song, there are calls for the South Korean government to prepare and take actions in terms of fiscal and monetary policies. What are your thoughts?
Recently, I have observed some practitioners or economists, I'm not sure, but they have mentioned because of the trade barrier is increased against world by under the Donald Trump, then our corporations or firms are going to invest more in the U.S. territory. But that is a very, very wrong judgment, I think, because of when there is a barrier, don't have to try to thrust the U.S. market anymore. Just let them do what they want to. And then we need to expand our trade and our relationship and economic resilience through the expanding our trade with other countries. That is a much better alternative, and particularly the South Korean domestic economy suffers. I very worry about some very close to deflation because of this October's producer price index in Korea has been negative at 0.1%, and we just narrowly avoided technical recession for the 2 consecutive quarters. So that implies that our economy is rather very close to some near zero inflation or deflation and the stagnant economy. So that's my really serious concern about that.
Right, so we will have to be prepared to look for alternatives as well. I'm afraid we'll have to leave our discussion right here. Many thanks to Professor Song and Professor Kim for sharing your expertise tonight. We appreciate it.
Thank you.
Thank you for joining us on Within the Frame. Be sure to tune in next time as we continue to explore the stories that matter. Until then, stay informed and engaged.